Hey everybody, how are ya? First, thanks for having me here. If you don't know who I am, my name is Sebastian. Um, I was a trader on the floor of the Amex and the SIBO for a very long time. I loved that part. And then after I left, I started doing a little bit of education, worked with some different people, and kind of realized that um, people really don't understand, I think, the important pieces of options, and that's really what messes them up. So I started Option Pit, and what we try to do is teach people how to really think about options, how volatility works, how professionals approach trading options. And if you want to check us out, I put out a volatility newspaper called the VIX Edge. Every single day, I do a rundown on what's going on with VIX and other stuff in the vol space. 3 days a week, I put out a more trading-centric piece called the Pit Report. We have a writer that does bonds and gold and silver and commodities. That's called Power Income. We have a letter called Power Moves that is written by our DC insider. We have our general counsel / writer was worked on the Hill and then worked on Wall Street for a number of years. And what he does is bring together how policy is affecting the stock market. And then finally, Leisha Leslie, who was another trader on the floor for about 17 years, writes a piece called Profits and Pumps, where she develops how to trade spreads. All of this is free. You just have to come to Option Pit, give us your email, and we will start sending you whatever you want. You can sign up for one letter or all of them. We'd love to have you. So what I'm going to talk about today really relates to VIX and volatility. Why? Well, the VIX closed 1596 today. And this is really, in the last year, only the second time we've closed below 16. We've only been below 17 a handful of times. And really, our first kind of dance with the way things were pre-pandemic. And what I hear from people when the VIX gets this low is, hey, Mark, is it time to hedge? Hey, Mark, is it time for us to start buying protection? How do I know when the next big sell-off is coming? And where's the VIX going next? Those are the questions I get. So let me start with where I think the VIX is going next. And what I want to do is kind of pull up a chart of the VIX here, and I'm going to show you what I think. So here we are. Here's the VIX in the last 2 years. I'm going to tighten this up a little bit so that we just kind of pull in the pandemic. So I'm going to take it to about January of 2020. And I want to point out a pattern. And I don't believe in a bunch of technical analysis on the VIX. I'm not in favor of that. But what I do want to point out is that you can sense calming when the VIX is getting lower lows and lower highs. And from the peak, we basically went straight down and then kind of found a level that we wanted to hang around at for a very long time. And this level was in between 20 and 30, and we would have these spikes. All right, so kind of consider this our level. Pull that out there. So this is our level. And over the course of about a year, we've seen the VIX kind of hit lower lows and lower highs. All right, this candle, lower lows, lower highs. And then it gets worse, went from here to here. And then from here to where we were now. And now we're at a spot where kind of our normal level, that kind of 25 level that we would hang out, is really far away from where the VIX is trading. And a spike in the VIX is now back over 20. We saw spikes in the VIX last Friday where we briefly got over 20, and then they gave it right away. And this is key because there's a big difference between a VIX spike and a VIX, what I call a VIX swell. All right. And a VIX spike is what we saw last Friday. It's a 1, maybe 2-day event in volatility where volatility explodes higher. And then just as quickly as it goes up, it goes down. And if you look at what happened, we basically popped and then have just been on a one-way ticket lower since last Friday. Volatility has absolutely gotten face punched. Now, the last kind of VIX swell we had was kind of a mini one that really took place here. And this was a period where markets were choppy and volatility, while it didn't get really high, certainly jumped and stayed above where it had been for a long time. In this case, it was several weeks, about 3.5 weeks. A real classic example of a VIX swell forming is, I'm going to pull in a little tighter here. I want to take us back to August of last year. All right. And I'm going to stretch that out a little bit. August through kind of November. And what we saw was volatility go up and then really power higher. And then I think the important part is that it stayed there for a very long time. We've been trading lower and lower and lower, heading toward 20, and then all of a sudden we're back hanging around 30 for what amounted to about 2 months before we finally blew higher to about 42 and then gave up the ghost. All right. What you're looking at, someone's asking what trading platform I'm using. This is VolTrader, Sterling VolTrader. It is a kind of a ugly stepsister of LiveVol Pro. And I will be using LiveVol Pro some. We're going to look at use Thinkorswim, and we're going to use this VolTrader. So how do you spot a swell? Right? Because that's really what matters. We don't care about these VIX spikes. They happen. It's life, right? It's not something you need to worry about predicting or even need to, take a lot of account in. And so what I'm going to do is show you how I spot a swell. And the way I spot a swell is using my VIX traffic light. By VIX traffic light, three colors, right? Red, VIX is going to drop or stay stable, meander lower, and we should not expect a lot of big volatility. The yellow light is when we see the VIX starting to say, hey, we're getting into some warning level. We're getting a little scared here. And so a yellow light doesn't necessarily mean the VIX is going to go higher. What it means is that we're likely to see big movements in volatility, both up and down. So on Friday afternoon, I did get a yellow light. My VIX signal tripped. At by the minimum amount that it can, my VIX signal tripped, saying we were going to get some big moves. Well, we did. We just got them in the direction that maybe a lot of people weren't looking for. We got them down instead of up. And then a green light means volatility is likely to go up. Volatility is likely to go up. So how do I approach my trading? How am I behaving from the long side? Most of the time I'm long, just like you. Well, when I'm in my red signal, I'm generally not really worried about the market. I'm trading what's in front of me. Generally, the market goes higher. I end up in a lot of calls. I do trade a lot of puts too, but I would say 70% of my executions are calls. Then, when we get to that yellow light, I'll start looking at hedging. I'll start taking winners off. I'll pare down my volatility or put some hedges over the top, but I'm not actively getting long volatility. I'm still leaning short volatility, but I'm playing for VIX to move. And when VIX moves, that means the whole market will move. So I'm generally a little more non-directional. I'm looking for wild moves, but I'm not looking for the market to go up. Then, when I get green, that is when I will go full on hedge, full on long volatility, short the market. I'll play long puts. I'll put most of my portfolio in cash. Okay. Well, I manage a hedge fund, and when we're in that green signal, we'll go to cash. All right. And believe it or not, we hit this green light in February of last year. And I want to show you this. And then I'm going to walk through exactly what I look at for my traffic light. All right. I want you guys to understand how this thing is built, because it took a lot of work. So I want you guys to have a really clear understanding. So I'm going to tighten this up a lot. And what I want you to think back to where we were in January and February of 2020. What was going on? Do you guys remember? The market was going straight up. We were still in the zone of the market going up. So what tripped my signal in VIX? A couple of things. And what I'm going to do first is show you when the signal's tripped, and then I'm going to show you how they work. So we really saw what I would say the beginning of the pandemic trade was on February 24th. I was in cash on February 20th. All right, so what happened? Well, here is when my yellow light trips. And you guys probably don't sit there and stare at the markets all day, but I'll tell you what happened on this day. In the middle of the day, somebody dumped a monumental amount of S&P 500 futures, and we dropped about 30 points in maybe 5 minutes and then rallied all the way back. But when we did that, volatility stayed bid and my light went to yellow. The next day, all right, was expiration. The next day was expiration. So I got a little lucky here because I'm still in a yellow light. Now, the Thursday before expiration, before SPX expiration, I usually close my position and then roll out to the next month. Now, seeing my yellow light trip, plus that weird behavior, that's the one thing where, me having 20 years of this works to my advantage. Seeing what had just happened, I said, you know what I'm going to do? And maybe I'll lose a little bit here, but I want to see what happens tomorrow. And when we came in the next day, market was getting beaten bad and VIX was really going higher and my light tripped to green. And so I said, you know what? I'm not even going to buy. Instead, what I did was I went long volatility. I actually bought calls on VXX, something I almost never do on VIX. All right, so now that I've kind of explained when it's worked and how, you're probably asking, okay, what goes into this? And the indicator uses 4 parts, all right, 4 main parts. two that are very important and two that are secondary. I'm going to go through the secondary ones first. So the first one I really pay attention to is VIX volatility. And by that I mean, let me pull up the vol chart here. What is movement of VIX and VIX futures doing? All right. And what I'm careful about and looking for is a change in trend. A big change in trend. Is volatility increasing slowly? Are we starting to see some momentum for movement pick up in VIX? And what I would say is from the beginning of June all the way through last Friday, we saw that volatility pick up. And it was really, this was one of the indicators that flipped to yellow on the 18th, because we'd seen volatility absolutely and unequivocally move higher. We'd gone from a realized volatility, how much the VIX is actually moving, of 80 up to 110. All right, that moved me from a red to a yellow. All right, a little more, and we go a little more with VIX going up, and it would have gone green. So remember, the VIX needs to be stable or rallying, and realized volatility starting to increase. All right, indicator number 2 is VVIX. All right, you're saying, what is VVIX? VVIX is the VIX of VIX. So it is the volatility index on VIX options. Again, what I'm concerned about is when VIX is stable or dropping, and we start to see the VVIX starting to rally. And what do you know? Same thing. We get a nice move on June 1st, can kind of ignore it, but then by the middle of, June 8th, VVIX is really starting to rally, and we pop out on the 18th at 132. There's a clear trend of demand for VIX options. When there's demand for VIX options, that's the market telling you it's starting to get nervous. That we have some real reasons to be afraid. So there are my two kind of minor indicators. My next two indicators are a lot more important. And the first one we're going to look at, and here's where, don't worry folks, see, we're going to pull up Thinkorswim. Yay! I know everyone loves it. Now, what I'm looking for, and this never tripped, is a change in correlation. So the VIX index is supposed to negatively correlate with the S&P, right? VIX is the volatility index. It is telling us what demand there is for S&P options. When the S&P is rallying, we tend to see demand for S&P options drop. So the VIX tends to drop. When the S&P is selling off, we see demand for options increase, and we see VIX go up. Now, what I'm watching for is when these two aren't doing what they're supposed to. When the VIX starts to correlate with the S&P 500. When we see the VIX rallying with the S&P. Now, here's the thing. With Friday's little pop, we never really saw that change in correlation. We never really saw VIX going up with the S&P. We had one day where that happened. Here. All right, we literally had one day where the two moved together. That's not enough to get my attention. One day that doesn't. I'm usually looking for 3 to 4 days. So when we see these two start to correlate, that is what gives us pause. So now what I'm going to do is I'm going to pull in closer to this year, and I want to show you how we saw this little VIX swell starting to develop. And it starts on April 19th. So here we are looking at the S&P and the VIX. And what I want to point out is, check this out. We're higher. VIX is trending higher. And that was our warning sign. That was our sign that, hey, maybe there's a problem here. Let me auto zoom that out. I'm not quite where I need to be here. There we go. So we saw these indexes rallying together. I don't like when that happens. I don't like when that happens. And what was that telling me? Well, we may be in for some fireworks. And lo and behold, we got some fireworks. Volatility stayed elevated from about May 10th through May 25th. May 25th is about when things started back to normal. So we're talking about a 3 trading week period. All right. And so that was what I would call like a mini swell. And in front of every major VIX event is this change in correlation. I'm not kidding you. So why don't we go back to, let me clear my drawings here. Why don't we go back to last year and look what happens there? And we'll look from, January 27th through March 3rd. I have to change this to a 2-year chart. And we'll do the same thing. March 3rd. Here we go. All right. All right, so I've got the 31st here. That's fine. And then, so we're going to go from March 31st on. And then I am going to take this out to the 2nd because I want these two to match up so that you can clearly see what's going on. There we go. And what I want to point out is that look at VIX as it's going up over the course of a week. And look at what the S&P is doing at the same time. The S&P at the same time is stable, even rallying a little bit through this entire period. So you have the S&P stable, maybe even going up a little bit, and you have the VIX meandering its way higher. That's a bad sign. This is I was already watching the VIX before the 19th. So when you see that correlation, that is when you have a problem. The same is true on the downside, though. When these two start to correlate, you are about done. Get these guys to match up entirely. There we go. And what I want to point out is that the bottom for the S&P and the top for the VIX don't match up. Look, Top of the VIX is on March 13th. Or excuse me, March 16th. Here's March 16th. That was not the bottom. But what was interesting is that from March 16th through March 23rd, the S&P dropped almost 200 points. Over that same period, VIX is down. VIX is not just down, it's down a lot. That's my go signal to start dabbling in short puts. So some things I did, I sold the January 2021 2,000 puts. 2,000 puts at $200. Think about that. So that is when you'll see things absolutely blow up. Down and up. That's where we find our bottoms. And we see it over and over and over again. So when we see VIX and S&P start to correlate, that is when you are at your peaks and at your bottoms. All right, final part of my traffic light, all right, is VIX futures term structure. All right, so there's no way to actually trade the VIX. The only way to trade VIX is through VIX futures. VIX futures are European, which means when the VIX is, which means there's no early exercise. So they don't move exactly the same way as the VIX. They're trying to predict where VIX will be when they expire. So when the VIX is low, futures tend to trade at a premium. When VIX is high, futures tend to trade at a discount. So what you're looking at here is called a VIX contango. A VIX contango produces a red light for VIX. This is the number one most important piece of my traffic light. So when we're in a contango, markets are generally gonna move higher. And we never left a contango at any point during the sell-off. Here's last Friday. They're higher. Notice that this spread has tightened up. The spread between the VIX and the VIX future has tightened up. But the whole curve is still in a pretty decent contango. So this stayed red. All right, so my two lower indicators went yellow, and my two more important indicators stayed red. So I could have stayed red on Friday night, or I could switch it to yellow. I switched to yellow because I could tell we were going to get some sort of wild move. I just wasn't sure what direction. The answer was down. All right, so what produces a yellow light? Well, why don't we go back to February of 2020? We'll go to the 11th. So here is the VIX and the VIX futures curve. And again, remember, we started paying attention to this several days before the sell-off happened. And what's going on here? Well, that's not a really steep contango. The curve is really flat. All right, we've got a really flat curve. And by the time we get to the 18th and the 19th, we now have the cash and the future trading on top of each other. They're literally trading on top of each other. Now we got a little nicer contango, but I don't like that the cash and the future are right on top of each other. All right. And so we get this production of a yellow light. All right, and then on the 21st, and here's like a really good yellow light on the 21st. So on the 21st, we've got a yellow light on my contango calculator, right? Look how flat this is. The whole curve from March through September of 2020 is trading within 70 cents. All right, look at where this curve is now. July is 18. And the same distance further back, January, is 23. Gotta go back to my dates. So now, on that Friday, we've got this messy curve. We have the VIX, so I've got a green light for volatility coming out of my contango calculator, or coming out of my correlation. My volatility of VIX picking up, green light. My VVIX light, green. This is yellow. This is also the slowest to react. 3 greens and a yellow is a green light for volatility. I am not going to go long a bunch of equities when that happens. And lo and behold, I went on national TV this day on February 21st and said, I think we're setting up for an incredibly ugly Monday. I said liquidity stinks and the market is sick and we could sell off. And what made me so confident in that is that my volatility light was saying, hey, vol's going up. And boy, did it ever. Because here we are on Monday. Now my final light, my VIX futures term structure piece of my VIX traffic light is telling me green. So we're green, 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 green. Now's the time to go long volatility. That is how I spot sell-offs and rallies before they happen or as they happen. All right. Does anybody have any questions on what I just went through?
I got one quick one, Mark.
Sure.
You mentioned VVIX as
Yes.
one of the inputs to your traffic lights, and also you mentioned volatility of VIX.
Yes.
Are they basically the same thing, or are there differences?
No. So VVIX is implied volatility of the VIX options. Volatility on VIX is how much it's actually moving. So one, I'm looking at realized volatility or historical volatility in VIX. The other one is implied volatility on VIX options. So
Perfect.
Those two are, they sound similar, but they're very different things. One is how much is the VIX actually moving. The other one is where's implied volatility of VIX options. And implied volatility on VIX options tends to react before S&P options start to move, which I think is kind of interesting.
No, that's fascinating.
Yeah. Hopefully I'm not losing people because I know that this is probably a lot to swallow, but it's really important. So now, where are we now? Right? Where are we? We got the VIX at 1595. Well, I'm going to tell you, I want to be short volatility. Every single one of my indicators is saying volatility is probably going to keep dropping. I think we're going to be below 15 by next Friday, maybe this Friday. And I think the VIX futures, I think this July future will be maybe touch 17 by the time we get to next Friday. I think it's put a lot of pressure on volatility. So how am I trading VIX? And I'll briefly go through that. Well, there's a couple things I do. And what I want to start with is how amazing VIX options are. So VIX options, and this is important, VIX options, the underlying for VIX options is not the cash VIX. It is the VIX future. So every single option contract, it has its own underlying. So the underlying for the July option is the July future, which is 1810. Now, here's the important thing to remember though. Eventually, at expiration, VIX and that July future need to be at the same spot. They need to, because the VIX, that July future is going to expire into the VIX cash print. So as we get closer to expiration, that contango gets tighter and tighter and tighter until it goes poof. So now, what does that mean for how I trade options? Well, I want to look at July. Okay, so the VIX is 1596. The July future is 1810. So there is a $2.15 difference between the two. What if I told you I could create a trade that returned 1-to-1 that was also long gamma and the VIX doesn't have to move? What would you think about that? Well, I can do that. I can do that right now. So I'm going to show you this. So we're going to go to July. And, you know what, we'll use Thinkorswim. We'll use Thinkorswim so that you guys have. All right, so here we are, VIX 1597. Let me get rid of that. So I'm going to look at the July options. They have 26 days to expire. The 18 puts are going to cost me $1.90. All right, well, what is 18 minus $1.90? Anybody? 18 minus $1.90. 1610. Am I right? We all are able to do basic arithmetic? Right? Everybody here good? Everyone passed third grade math, right? All right, good. It's 1610. So let's do some math here. I can buy this put option that if the VIX does nothing, I make 13 cents. Should I be able to do that? I shouldn't. All right, well, what if I sell the 15 put at, I don't know, let's say 35 cents? Well, now that drops my price to $1.55. All right, it drops my price to $1.55. Well, now how does this position make money? Let's look at the risk. Well, remember the VIX is, I'm going to put the VIX price here. The VIX is 1595, 1596. So we'll put that right here. So if I put this position on and the VIX doesn't go anywhere, I paid $1.55 and my position will make $50. It's a 33% return and the underlying doesn't even have to do anything. In fact, If the VIX goes up a little bit to 16 and a quarter, I make money. Now, what if, remember, I said I think VIX is going to 15. All right, well, if we go to 15, at expiration, I'm making $145 against risk of $155. It's a little under 1-to-1, but pretty much 1-to-1. So I've got a trade that can win if VIX goes up a little bit, if VIX stays flat, or if VIX goes down. And I just have to sit back and wait. It's like being short a credit spread, except you're not short a credit spread. You're long a put spread. This is the only product that you will see that traded. And I love these setups. Love this trade. All right, now, the other way I use this is in VXX and UVXY. And one of the things we have at Option Pit that I'm not going to show you is we have a calculator that literally tells me how much VXX and UVXY are going to lose a day. And then we can forecast where we think VIX could go, and it'll actually tell us exactly where these ETFs and ETPs will be if VIX goes there. It's some kind of cool proprietary stuff that we have. And why can't we do the same trade on the call side as the credit spread, which has a higher probability? It actually has the exact same probability. Remember, a put is a call and a call is a put. The reason why you don't want to do it in the calls is that liquidity starts to dry up. So if you look at how these guys are trading, with VIX, calls tend to trade, out of the money calls trade a lot more than in the money calls. So look, like the 15 calls only traded 369 contracts, the 16, 780, the 18's about 1,000. The 17 puts traded 30,000 contracts today. So you're going to get much better execution and fulfillment on your trade trading the puts. Good question, though. So what I'm using this calculator to do is to tell me, okay, one, is it safe to be short UVXY or VXX? My stop signal, my stop light, tells me yes, it is. Then I'm using my calculator to actually set up where I want to put my trade on. All right. So there you kind of have it. That is how my entire system works. Now you're saying, Mark, that's a lot. I don't want to do that all the time. Here's the good news. You can pay me to do it for you. We have a product called the Volatility Edge. I'm going to drop it in the chat right now. And we're doing something special. So with my volatility product, I'm putting out 1 to 2 trades a week that get emailed and texted. And they're going to be on VIX, UVXY, VXX. There's going to be a little SPX and a little SPY as well. We put out 1 to 2 trades a week with a write-up, with a plan. They go email and text. On Mondays, you meet with me every Monday at noon. And I go through what is volatility doing, what does my weekly forecast look like, what events could affect us, and what is my portfolio doing and how am I managing it. We have a volatility course built in there that is really, really good. It's a masterclass on volatility. And so if you're saying, Mark, there's a lot for me to understand, but I really want to learn from you, great. You have this amazing volatility course that comes with it. All right. And then you're also going to get access to my daily traffic light. Every day in the morning, I go in and I update my traffic light for both VIX, and then I have one for the S&P. All right. And then we also have kind of a fun crypto event coming up. And for the month of July, I mentioned Power Income. That's Bill Griffo. He was a trader on for Bear Stearns for about 30 years. Traded bonds, gold, silver, you name it. He is doing a trade a week every Thursday. There's 5 Thursdays in July. He's doing a trade every Thursday in July on gold, silver, and the gold miners. And that is coming with this as well. Now, we sell this without the Bill Griffo stuff for $499 a quarter. $499 a quarter. All right. It's a steal there. I pay for it typically on 1 or 2 trades. But if you sign up by tomorrow, tomorrow being Friday, because that's when my phone crew is in, and you can do it by either clicking on this link or by calling my customer service rep. His name is Ted. Our number is 888-872-3301. If you do either of those, we'll give you the price for $299. So basically $99 a month. I should pay for that in like 1 trade. So for instance, I closed 2 trades today that paid for that each. All right. The 1 trade I closed today was on UVXY. I was long the July 2nd 31 puts. I bought them for $2. I only bought 2 of them. So I spent $400. I sold one at $3.20, and I sold a second at $3.95. All told, it's a little over $300. All right. So I literally paid for it in 1 trade. So the question is, what is the usual margin for your trades? I run my portfolio with my trades usually around $500 or less. So I'll do, in the case of the UVXY, I bought 2 puts. Total cost was $400. All right. Sometimes I'll do some longer dated trades, some trades that are just kind of, I want to put on and then not worry about them until August and then take them off with a bunch of money in my pocket. Those might be closer to 1,000. But most of the trades are going to be around $500. So we're not talking a lot of money either. I trade this as if it is about a $10,000 portfolio. All right. And so, yeah, you're getting just a ton. What is our ROI in how many days? I mean, I don't know. What's the ROI on 74% in 3 days? Here's what I'll say. We don't have a lot of people sign out of the service. And if you log in, you can see the whole track record. We've done really well. I win probably about 70-75% of the time. Don't quote me on any of these numbers because I don't have the stats directly in front of me. So, ballpark, I'm winning about 70% of the time. And I am, and my wins are way bigger than my losses. Now, here's one more little kicker. I think you guys had Andrew here last time. Is that right? Is that right, Don? Yeah, I think we had Andrew. Andrew is my number 2. He runs a program called the Volatility Trading Club. And it's a little more advanced. Trades, it basically is a system to short volatility but have a hedge on, and then eventually convert that hedge into a free long volatility call. All right. I'm going to include that with VIX, the volatility edge through tomorrow for everyone here. Nobody else gets that, but this club, because you guys are invited me to speak, because you're a good people, I'm going to include that with you because I think you guys know and like Andrew. So that's going to be a gift. What are the capital requirements and how much margin? So at any given time, I'll probably have 3 or 4 trades on. I think I've had as many as 5. And if they're all between, $500 at the most, $1,000, you're really talking about $3,000 I'm using. Obviously, you can adjust these to your own portfolio, right? I did 2 of those UVXY trades for $400. If you want to follow along on the trade, you can do 1 for $200, like that. So, but my model portfolio runs about 500 to 1,000 a trade, and then that allows you to adjust your sizing accordingly to you. Because again, I'm trying to teach you guys. The whole point of this service is to teach you how I think, how I trade. That's why I meet with you every Monday, so I can really explain my logic. And really, I said $2.99, not even $3.99. All right. So, there you have it. I would love to have each of you involved. Need to sign up by tomorrow. All right, because and with the Volatility Trading Club that we sell at $5,000, you're getting 3 months of access to that. Tell us more about the 12-hour course on how to hedge your portfolio. Our masterclass is actually 15 hours long, and it's 12 parts and walks you through really the basics of understanding volatility all the way through building an entire volatility portfolio. It's awesome. And do I have any courses on pricing options chain based on volatility, term structure, continuous contract, growth data, how a market maker does? Kind of everything we do is from that mindset, right? You're not actively pricing because you're not making markets, but I teach you how the market makers think and how to take advantage of the way they're trading to catch them sleeping. All right. And again, our number, if you want to call in, is 888-872-3301. I'll take a few more questions, but then I have to go help with my kids.
Sure. So until what time tomorrow could people call that number?
Teddy usually is done about 5 o'clock Eastern time.
5 p.m. Eastern time. Fair enough.
All right.
And there's your number. There's the number to order.
Mm-hmm. And here's the link to sign up. And yeah, that Bill Griffo trade a week and Thursday, I was calling it 5 for the 4th of July. It's really fascinating stuff that he's doing. And the way he's analyzing gold, junior miners, regular miners, oil. The guy knows everything about interest rates and currency that you could imagine. It's pretty fascinating. So, I mean,
super. Does anyone, let's see. Mark offered to answer questions, so maybe in the interest of time, just turn on your mic and ask one if you have any, and then Mark has to go. But does anyone have any other questions? Let's wait a second and see if anyone.
I think it should be $2.99. If you sign up and it's $4.99, I'll rebate the $200 back. Don't worry about it. I don't need I'm not here to try and trick you guys. Who do you place your trades through? I use LiveVol. I use Thinkorswim. I have accounts at Fidelity. I've had accounts at Charles Schwab. I pretty much don't care who I trade on. When I'm trading with the fund, I use I have what they call DMA, which is direct market access. And I have a little program called Matrix that looks like that. So
Do you find, I'll just ask one while we're, if I may, you mentioned you're using the LiveVol product, and I know that's available through some deals through Interactive Brokers, which is sort of Byzantine process to get that deal.
yeah.
But overall, do you think it's worthwhile for people to get that?
Yeah, so we actually are bulk buyers of LiveVol Pro at Option Pit. And so our clients get it at a $100 a month discount
Oh, really?
when they buy through us, but you have to be a client.
So like taking
and
up this offer.
and it's $250 a month, and it pays for itself every day.
So that's after the $100 discount or before?
Yep.
Okay,
Yep.
after.
But it's totally worth it. And the one through Interactive Brokers, I mean, if you're gonna open an Interactive Brokers account, why not get the Sterling Vol Trader over the top of it? It's pretty nice.
Sure.
And I think you get better commission rates too. So if you want, if you're interested in Sterling Vol, I'll intro you to my contact at Sterling. He's actually a former colleague of mine, really good dude. So I'll send you over that way.
I think we'll look for a demo in a future meeting of that also. Okay. Anybody else have any questions? Mark has to go fairly soon.
All right. Well, doesn't look like it. I hope everybody has a great day, a good rest of your evening. Guys, thanks for inviting me. I'd love to come back some other time. I really appreciate you guys doing this.